Hello guys. Today we are going to discuss a very important concept in the financial reporting in the FA1, which is an accounting equation. Accounting equation is basically it's a fundamental to the application of double entry bookkeeping, where every transaction has dual effects on the financial statements. So, whenever we have to start the accounting, the very first step is to prepare the accounting equation. In accounting equation, there are basically three components, and that are very important components. So we will be considering the three components: capital, assets, and liabilities. Before considering and before learning what is capital, what are the assets, what are the liabilities, you need to know that what is a very important concept that is called business entity or separate entity concept. Remember one thing, that businesses, according to separate entity concept or business entity concepts, business is legally separate from its owners. Although we will be discussing in the next videos that what are the types of businesses, there are different types: sole traders, partnership, and further there are two types of partnership: general partnerships, limited liability partnerships, and then companies, and then there are different types of business. But there is a very important concept, that is business is legally separate from its owner. So we only are accountable. We will be recording all the transactions according to the business, with the aspect of the business. Okay. So remember that what is accounting equation? Accounting equation is capital is equal to assets minus liability, or thus if I write there are standard form of accounting equation. Standard form of equation is basically assets is equal to liability plus capital. Okay. So if we talk about theoretically that what are the assets and what is the right hand side of the accounting equation. So assets are basically resources owned by business. Resources owned by businesses. So any resource, anything that is owned by business is said to be assets. For example, business have buildings, motor vehicles, also land and building, property, plant and equipment, and so on. There are a different and number of types of assets. I will discuss all the types of assets in the heading of assets, then when we will be studying that what are the assets, what are the liabilities, and what are the capital. So assets is basically resources owned by business, and the right hand side of the accounting equation, if we talk about conceptually, theoretically, the right hand side, the liability plus capital, is basically resources supplied to business. These are basically resources owned by other companies, but these are resources supplied by other companies to our business. So these are, in short, the right hand side, liability plus capital, is basically resources supplied. Now, how it is said to be resources supplied? For example, if company A, if any company took loan from the bank, loan from bank, for example, $6 million. So this $6 million is basically resource but this resource is supplied by other company, which is a financial institution. Similarly, what is capital? Basically, the very fundamental definition of capital is resource or investments or funds supplied by the owner, funds provided by the owners of the businesses. Okay, so capital can be defined as being the residual interest in the assets of a business after deducting all of its liabilities. This is another formal definition of capital, is that if you deduct all the liabilities from the assets of the businesses, the residual interest will be the capital. So that is what would be left if business sold all of its assets and settled all of its liabilities. So after settling all the liabilities and after selling all the assets, what is remaining? That is capital. So in the case of limited liability company, we will discuss in the business organization chapter that what are the types of businesses, what are the types of companies would the capital would be preferred to as equity. Okay, so capital essentially represents how much the owners have invested. As I told you, that what is capital? Investment funds provided by the owners of the businesses. For example, whenever anyone wants to start a business, he or she have to put money into the businesses. So that investments basically, although that is initial investments, we will discuss the different types of capital, capital, initial capital, closing capital, opening capital, capital introduced during the year, but that is invested into the business along with an accumulated retained profits and losses. Remember one thing, this is basically, although this is basically a source of finance for the business, but this retained profit or retained losses will not be available for new business. Why? Because it is a new business, the business has not started their operation officially, so they will have, the business will have no profit or loss, obviously. For example, if you were to start a sole trader business, for example, it is a very basic type of a business, types of business, with 100,000 in with $1,000 investments, then on the first day of the trading on the accounts of the business would show that, okay, so what is basically, I will show you how to record this transaction in the accounting equation. Before I record this transaction in the accounting equation, remember one important thing is that increase, we will be recording, we will be adding increase in, either it is increase in assets, increase in liabilities, increase in capital. So we will add these things into the accounting equation. So if assets are increasing, if liabilities are increasing, if capital are increasing, so this means that we will adding the values into the accounting equation. Similarly, or vice versa, is if there is decrease in assets, if assets are decreasing, if liabilities are decreasing, if capital is decreasing, so we will deduct anything that will cause the assets to reduce, cause the liability to reduce, cause the capital to reduce. Okay, for example, the transaction number 1 is uh, ABC is a person, we can say, as a hypothetical example, started business by investing $1,000. So if you look carefully, I told you at the very start that business is separate from its owners. We will consider anything and all the things, all the transactions as per aspect of the business. Okay, so what is happening for the business? If you look carefully, business is receiving cash, business is receiving cash, and cash is asset of business. So assets are increasing. This is one aspect. Remember a very important concept. It's a concept number 2, duality concept. Duality concept, what does duality concept say? Is that every transaction will have two or will have double effect. Every transaction will have dual effect. So whenever you see a transaction, you need one thing will come into your mind, or should come into your mind, must come into your mind, that okay, it's a transaction and it will have dual effect. So one effect identify is that business is receiving cash, cash is asset of business, so asset is increasing. Okay, now what will be the second impact? Second impact is its investment by owner. So he is the owner, he is investing in business. So as I told you that what is capital? Investments, fund provided by the businesses, by the owners towards business. So second impact is capital is increasing by 1000. If we go to the accounting equation, we have assets is equal to liability plus capital. So in our example, there is increase in assets, category cash, liability is 0, capital is increased by 1000. So capital is also increased by 1000. So if you remember important rule, that after every transaction, accounting equation must hold equal. So the transaction has been recorded in the accounting equation. If you see, if you look after the transaction has been recorded in the accounting equation, two sides are equal. Okay, so this is basically, remember, after every transaction, assets must hold, accounting equation must hold equal. Okay, so this is a very basic example of recording an investment, recording funds provided by the owner of a business in accounting equation. Okay, now we will discuss in this format. The formula more clearly shows how the assets controlled by the businesses have been funded. So this is through investments from the owners, that is called capital, or by amounts owed to creditors. What is actually saying, whatever the assets business has, how it is funded, where does money comes from, whether the so there are only two sources. Remember one thing, businesses will have only two sources of finance. Business has two sources of finance. Two sources of finance means that where will from the business will receive money to purchase the assets, to fund the assets, to fund the operations. So either it will be capital or it will be debt, it will be liability. Okay, so now I will read this para again. In this format, the formula more clearly shows how the assets controlled by the businesses have been funded. Where does money comes from to purchase these assets? For example, business have bought a machinery. Where business generated this money? Maybe this money came from the provided by the owner, so we will say that it's capital. Maybe business have purchased the asset on credit basis, so it is a liability. So this is through investments from the owners or by amounts owed to business. You may also notice two other interesting points regarding the formula is that it reflects the format of statement of financial position. We will discuss, this is basically accounting statements. Okay, we will discuss at the end of this is basically the last step of recording the transactions. First we will record accounting equation, then we will use a double entry system to record transaction in the ledgers, then we will prepare trial balance, then financial statements. So one type of financial statement is statement of financial position. So that is assets are presented first and the total assets figure balances with the total amount of equity and liability. The equation that I wrote, that I said that it is a standard form of accounting equation, it's look similarly to the balance sheet, to the statement of financial position. Second thing is that it more clearly reflects the fact that total debits will always equal total credits. That is, assets is debit, capital is always credit, liability is always credit. Remember one thing, I will tell you a mnemonic to memorize the things. One is dead. Second one is CLIC. So what does it mean? Here, first D is for debit. We will debit expenses, assets, drawings. First C is credit. So credit, we will credit the liability whenever there is increase in liability, income whenever there is income, and capital. Remember two important things relating to these two mnemonics, that increase when I say that debit assets. So when I say that debit assets, so this means that this is increase in assets. So whenever assets are increasing, increase in assets is debit, and vice versa, decrease in asset is credit. Credit. Similarly, increase in liability is credit, vice versa, decrease in liability, debit. Okay, so this is the a very basic and the description of accounting equation. In the next lecture and in the next class, we will discuss about drawings, income and expenses. So take care. Allah Hafiz.